Sage here for Kalkine Media. Subscribe to the channel and press the bell icon to be notified of our latest videos. Can inflation woes spark a firestorm in the global markets? The global equity markets are witnessing a sizable correction, and the reason? The credit may become costlier for the companies. In the past 7 days, two data sets on inflation came to light, and both presented a grim picture. The United States, the world's largest economy, reported that its inflation rose 4.2% in April from the year-ago period, a jump that is far higher than many analysts expected. The surge in retail prices in the US is the highest since 2008. In the Far East, the world's second largest economy, China, has seen its producer price index rise by 6.8% in April, the highest pace in almost 3.5 years. And this has set off concerns in the global markets. The central banks the investors fear would be considering a rate hike after this and doing away with the post-pandemic quantitative easing. If the central banks would increase the policy rates, it would automatically make the credit costlier for the companies and individuals alike. The credit will become costlier quickly, this time than the past incidences, as the central banks across the globe had made sure the policy transmission increases between 2018 to 2020, when the world was going through downward interest scenarios in the face of prolonged slowdowns. Now, this will not only make credit costlier for the companies, but also cause hindrances in the economic recovery after the 2020 recession, also referred to as COVID-19 recession. And then with rate hikes as the US dollar becomes stronger, there is global imminent sell-offs waiting in the wings. As soon as the dollar becomes stronger, the returns on investments in other countries for Wall Street companies start diminishing. This triggers a sell-off and further weakening of the local currency against the US dollar, thereby setting off a vicious cycle. In 2013, then Federal Reserve Chief Ben Bernanke spoke about doing away with the quantitative easing, which was initiated in 2008, and this led to equity markets meltdown across the globe. That was 2013. Almost 8 years later, the global markets are more interconnected and dependent on each other. A unilateral rate action by Federal Reserve, for example, will have far-reaching consequences for countries like India. And indeed, central banks are in for tricky times ahead, with a tough task at hand to strike a balance between economic recovery and inflation. If you like this information, please like, share and comment on the video below and subscribe to the channel. Press the bell icon to be notified of the latest videos, and for regular updates and information, please head to the website kalkinemedia.com. And this is Sage for Kalkine Media.